Why tech remains a strong bet amid economic shifts, a deep dive analysis. As we navigate the complex currents of today's financial markets, one sector continues to stand out as a beacon of growth and innovation: technology. Despite whispers of overvaluation and echoes of late 1990s market exuberance, the tech sector's robust fundamentals and the broader economic landscape suggest there's still significant upside. Let's unpack the reasons behind this enduring bullishness on tech, explore the role of AI infrastructure, and assess the broader economic indicators and policy dynamics that could shape the near-term trajectory of markets. Tech's unyielding growth engine, earnings, and beyond. The tech sector has been a juggernaut, posting double-digit earnings growth over the past few years. Even as revenue growth projections for the coming year show signs of moderation, the numbers remain compelling. This resilience is reminiscent of the late 1990s, a period marked by rapid tech expansion and frequent warnings of an impending collapse that didn't materialize until the dot-com bubble burst in 2000. While history doesn't repeat itself exactly, it often rhymes, and today's tech landscape feels like a mature bull market. The S&P 500, for instance, is trading at a lofty 27 times trailing earnings, a valuation that raises eyebrows but is underpinned by genuine growth in key sectors like tech. What sets this era apart is the transformative power of technology, particularly in areas like artificial intelligence, AI. AI infrastructure spending is growing at a staggering 42% annually, a pace unmatched since the advent of the personal computer. This isn't just hype. It's a structural shift that's redefining industries and creating new economic paradigms. While other parts of the economy, construction, industrial production, and manufacturing, lag behind with tepid growth, industrial production in the U.S. has risen just 1% and manufacturing employment has stagnated since March. Tech's outperformance suggests it's not just a cyclical winner, but a secular one. The broader economy, cautious but poised for recovery. Beyond tech, the rest of the economy tells a more cautious story. Consumer spending, a critical driver, has grown at a respectable 3.5% as of mid-Q3, reflecting resilience among households. However, business sentiment remains guarded. The ISM report indicates that 9 out of 10 industries are wary of potential disruptions, particularly around trade policies and tariffs, which have dented global economic momentum this year. Construction has contracted, and producers are hesitant to ramp up output despite steady demand. Yet, there's room for optimism. If macroeconomic policies stabilize, especially on the trade front, producers could align output more closely with demand, spurring a broader recovery. This isn't a guaranteed outcome, but it's a plausible scenario for 2025, especially if geopolitical tensions ease and policy uncertainty diminishes. The economy, while uneven, appears to have the potential to, quote, catch up to tech's torrid pace, creating a more balanced growth narrative. Cracks in credit markets, a warning or a blip? One area of concern is the credit market, where easing standards and isolated instances of fraud, amounting to a couple of $2 billion, have raised red flags. While these issues aren't indicative of systemic rot, they reflect a broader sentiment of unease. As recoveries mature, credit risks often emerge, and sectors like regional banking and autos are showing vulnerabilities. For investors, this suggests a need for selectivity, avoiding overexposure to industries with weaker fundamentals while focusing on areas with structural tailwinds like tech. This sentiment mirrors the late 1990s, when skepticism persisted even as markets soared. Many investors remain on the sidelines, fearing a repeat of past excesses. While caution is warranted, it's worth noting that today's market dynamics are supported by real earnings growth and innovation, unlike the speculative frenzy of the dot-com era. The Fed's role: cuts, balance sheets, and market expectations. Monetary policy remains a critical wildcard. Markets are pricing in a near-certain Federal Reserve rate cut in the coming weeks, a move that could provide further liquidity to an already buoyant market. Historically, Fed cuts of over 100 basis points have often signaled economic distress, but exceptions like the mid-1990s, when cuts supported a recalibration without derailing growth, offer a more hopeful precedent. Today, the Fed appears focused on a softening labor market, where job gains have slowed to a crawl, while corporate profits continue to surprise to the upside, with expected EPS growth exceeding 10% in the coming year. Interestingly, the Fed's actions may not be the linchpin for market performance. Even if rates are cut, a downturn in AI spending or broader economic weakness would overshadow any monetary stimulus. Conversely, the Fed's management of its balance sheet, having reduced securities holdings by over $2 trillion since 2019, has been more adept than in past cycles, avoiding the borrowing-lending contradictions of that period. Inflation, while elevated, is expected to moderate, providing a normalizing backdrop for markets. Historical context and global impacts. Looking back, the late 1990s provide a useful lens. That era saw tech-driven growth amid warnings of overvaluation, much like today. However, the global context has evolved. Back then, globalization was accelerating. Today, it's under strain from trade wars and geopolitical fragmentation. Tech's role as a global growth driver remains intact, but its benefits are unevenly distributed, with U.S. firms leading while other regions struggle to keep pace. This disparity could exacerbate economic imbalances if not addressed through coordinated policy or investment in lagging sectors. Sector-specific effects. Where to focus? Within the U.S., tech remains the clear leader, driven by AI and cloud computing. Conversely, sectors like regional banking and autos face headwinds from credit risks and cyclical slowdowns. Industrials and manufacturing, while lagging, could see a rebound if trade policies stabilize. Globally, emerging markets tied to tech supply chains, e.g., semiconductor production in Asia, stand to benefit from continued AI infrastructure spending, though they remain vulnerable to U.S.-China tensions. Conclusion: investment implications and near-term catalysts. For investors, the message is clear. Tech remains a compelling long-term bet, but selectivity and risk management are paramount. Focus on companies with strong earnings growth and exposure to AI and digital transformation, while avoiding overvalued or speculative names. Diversify into sectors with recovery potential, such as industrials, if macro conditions improve. Be cautious of credit-sensitive areas like regional banks and autos, where risks are mounting. Near-term catalysts to watch include the Fed's rate decision and any updates on trade policy, particularly post-election clarity in the U.S. earnings reports for Q4 2024 and early 2025 will be critical in validating tech's growth trajectory. On the policy front, any moves toward tariff relief or global trade stabilization could unlock broader economic upside. In this mature bull market, the tech sector's fundamentals offer a rare bright spot. Yet, as history teaches us, exuberance can turn to excess if unchecked. Stay vigilant, balance optimism with caution, and position for a future where innovation continues to drive returns, but not without bumps along the way.